Trading businesses buy and sell stock, and they record the movement of that stock in and out of their business by using a record called a stock card. For each type of stock that they trade with, they will hold a stock card. In this very simple business, they have one stock card because they only have one type of stock that is traded. It's a ride-on mower. Let's have a look at the stock card. It'll give the name of the stock somewhere on the stock card. It'll record the date of the transactions, the details, which refers to the documentary evidence of any transactions to do with stock. It'll show stock that comes in, stock that goes out, and it'll keep a running balance of the stock on hand at any point in time. Stock cards can be done manually or, of course, today electronically. Whether it's manual or electronic, the concepts are the same. Stock cards record the movements of stock in and out of the business, and it keeps a running balance of the stock on hand at any point in time. This first transaction down here is the business buying 3 mowers at $2,000 each. We're not including GST in this transaction. So let's record it. We just go to the date column 7/7, and we put the check number 56 in the details column. 3 mowers come in, $2,000 per unit, $6,000 worth of stock has come in, and that means, of course, that the balance goes up by 3 units to a total of $26,000 worth of stock. So the check has been recorded into the in column of the stock card, and the balance has been adjusted upwards. Of course, that check would also be recorded in the cash payments journal. This second transaction shows a cash sale, a sale of 2 mowers. We're not including GST in this example, and we just record that. Date 8th of the 7th, the receipt number goes in the details column. Because it's a sale, it's going to go out of the business, so 2 units go out at the original cost price. The stock card only records the cost price, not the selling price. So 2 units have gone out, so we're left with 11 units after that, and of course that brings us back to $22,000 worth of stock. This last transaction is a memo, and it says that the owner took 1 unit of stock for private use on the 29th. That's drawings, so 29, and the document here is a memo. It's drawings, so 1 goes out at $2,000, and so we're left with 10 units on hand, $2,000 per unit, and that of course equals $20,000. So at the end of this period of time, after 3 transactions, we have 10 units on hand, $2,000 each, a total of $20,000 worth of stock. And if we did a balance sheet at this particular point in time, we would record stock, a current asset, an asset to the business worth $20,000. Remember, in this business there is only one type of stock. It could be that a business has many different types of stock. Bunnings, for example, would have hundreds if not thousands of different lines of stock, and so the stock recorded in the balance sheet would equal the summation of all the individual stock cards. In this business, 1 stock card, and that total $20,000 equals the total reported in the balance sheet at that date, $20,000. In conclusion, the stock card is an important accounting record for a trading business. A trading business trades in stock in, stock out. The stock card is a record of those stock movements in and out of the business. It provides detailed information about the stock movements in and out of the business, and it does that for every single stock line. So if there's 20 different stock lines, there'll be 20 different stock cards. It's worth noting that the stock card will only record the stock at cost price, so we do not record the selling price of stock in the stock cards. And if there was GST included in the transactions, in this case I didn't include GST, but normally it would be GST. GST does not impact on the stock cards at all.